Hey there, everyone. Happy Monday. Happy New Year. Happy 2025. And welcome to a new year of Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a pretty consistently rainy Redmond, Washington. If you're familiar with the Pacific Northwest, we get pretty much consistent, kind of light, hazy, misty rain from November through April. And then it starts to become beautifully green. It's still green now, but just wet and green. We have nice long days in the summer, but short, rainy days right about now. Thoughts go out to those of you in a lot of parts of the country, particularly in the Northeast and the Mid-Atlantic, and even the South, dealing with snow, some freezing conditions, and a rough go of things. So hope you're enjoying the beauty of the white snow, but staying safe and getting around okay. Kind of a mixed day for the markets. This is our first live episode here, coming after a couple weeks off. We had a great visit to the Midwest and to the Southeast, visiting family for the holidays. I had a great time visiting family. Brought a pretty good cold along back with me, so I'm trying to take it easy and get back. So if I have to pause for a dramatic cough or so, I will do so. But great to be back with you. Super excited to get back into the swing. It's been a pleasure reacquainting myself with the charts and digging into things today, and I'll look forward to a lot of great episodes with you together. With that in mind, let's look at how the markets played out. Kind of a mixed day overall. Ended up the Dow being flat for the day, although earlier in the day, the all three major averages, the Dow, the Nasdaq, the S&P, having a decent up day, but in the morning, but then afternoon session, pretty much all those came down. It was enough for the Dow to finish slightly negative. The S&P was up about 0.6%, and the Nasdaq, the big winner, the Nasdaq Composite, was up about 1.25%. Mid caps up slightly, small caps down slightly. And I've done some work over the last couple of days doing some market outlook kind of stuff. I did a video for Stock Charts TV earlier today, which I hope you can check out as soon as it's posted. I don't know if it's up there just yet. Talking about the yield curve and interest rates, because the 10-year yield continues to push higher, around 4.6%. But when I'm thinking about key themes to look for here as we kick off this new year, obviously the market remarkably strong through the course of 2024, but quite a bit of weakness going into the holiday season. Santa Claus rally was essentially non-existent. The S&P was down during that Santa Claus period of 5 last trading days of 24, and the first 2 trading days of 25 were actually slightly negative. So do we see a reinitiation of this uptrend? Do we see leadership reexert itself? You are seeing that in some degree with stocks like Nvidia breaking out and having nice bounce of things, Meta and others pushing back towards all-time highs. One of the big question marks I think going into this year is, do you see small caps finally come into their own and have a little run at leadership? Not happening today. So the S&P 600 and the Russell 2000 down slightly today. The VIX around 16. End of last week we kind of got up into the upper teens, but we're still, by my sort of general definition, in a low volatility environment, with the VIX remaining below 20. So you did in the month of December see the MOVE index start to increase, trend higher. That's a volatility in the bond markets. The VIX, of course, volatility in the equity markets, and both of those derived from options, moving slightly higher, trending from the low teens to the higher teens, but still remaining below sort of those thresholds for a high volatility environment. So for now, the VIX sort of remaining in a bullish time frame, bullish framework, looking for the VIX to pop above 20 as a potential red flag of increased uncertainty, increased fear, and increased likelihood of the market going lower. Not seeing that yet. You're seeing the yield curve continue to have a normal shape, and some of the conversations I've had here over the last couple of days with my premium members, with some events that I've done over the weekend and now into this week, dealing with the interest rate environment. And what's happening is the yield curve is now in a normal shape, meaning the longer end of the curve, the 10-year and 30-year points, are higher than the shorter end of the curve, the 2-year point, the 3-month point. While the Fed is lowering the short end of the curve, the long end of the curve is actually pushing higher as bond prices are selling off. So the 10-year yield pushing higher, 30-year pushing higher today, continuing that trend that we observed really from mid-September now to early January. Rates have gone higher, and the 10-year yield has gone from about 3.6% in mid-September to around 4.6% here in early January. So some of those tailwinds for sectors or groups like home builders kind of not there anymore, right? Lower rates meant homes would be more affordable. Now all of a sudden you're seeing the 10-year yield go right back up toward highs from last summer, and really pushing back toward 5%, which was the so far the peak for this part of the cycle. Bond prices, of course, going down as yields are going higher. So the TLT, which is a bond ETF, down about 0.5%. The dollar index actually moving lower as well. And that's a trend we observed really through last Friday, a pretty consistent uptrend in the US dollar. And that has me sort of PTSD style, remembering the beginning of 2022, 2021, weaker dollar, stronger stocks. All of a sudden, 2022 begins, you have a stronger dollar, kind of weaker everything else. So warning sign to look for, number two, rise in the dollar, and a dollar pushing much higher than what we saw at the end of last year. For today, dollar coming back a bit. The UUP, which is a bullish dollar ETF, was down about 0.2%. Looking at the commodity space, you can see things like the DBC actually opened much higher, but traded lower through the course of the day. Gold and silver kind of mixed. Gold prices slightly lower, although still sort of in constructive patterns, I would say, overall on the medium-term time frame. Silver and copper prices both up. Crude oil slightly down. Natural gas popping higher in a big way. The UNG, which is a natural gas ETF, up about 10% today. Pretty significant move. Finally, cryptocurrencies. Since we last talked before the Christmas and New Year's holidays, Bitcoin sort of pushing back above 100,000. That really happened over the last 24 hours over the weekend and really through the holidays. Bitcoin sort of languishing in the mid to upper 90s. Today, we wake up and see Bitcoin pushing back higher. Big round number is pretty meaningful. So 100,000, sort of that general level that we're looking at. Constructive pattern overall, I would say, for Bitcoin. And today, up about 3.4%. Let's see if we can hold 100,000. We've failed to do so a number of times recently. And out of the things we just talked about, the GLD, Bitcoin, Ethereum are the three that I've shown you that I do own in my own accounts. All right, looking at the sectors, we can see that the technology sector, communication services, two of the three FANG sectors, along with consumer discretionary at the top of the leaderboard. Technology up the most, up 1.3%. We had some tech names up pretty big today. Communication services, number two, up 1.1%. Materials, third on the list today, up about 0.2%. 5 out of the 11 S&P sectors finished in the green today, which means just slightly over half were in the red. Now, one important thing, maybe the third warning sign to talk about. We talked about rates, we talked about the VIX, we talked about the dollar. Now let's talk about defensive sectors, right? When you have a market that's been in a nice uptrend and you're looking for some sign that that uptrend may be brought into question, signs that the strength that we've observed may be dissipating, I would look at defensive sectors and see if you recognize signs that institutional investors are rotating to more defensive positioning. The three sectors I'd watch for that are real estate, utilities, and consumer staples. And as you can see from the dashboard today, those are your three worst performing sectors today. So you're really not seeing any sort of defensive rotation today. That would be something I'm certainly looking for here in the days and weeks to come. Any signs that investors are kicking off 2024 or 2025, that is, by rotating to more the defensive side of the equity landscape. REITs, utilities, consumer staples, the three sectors down over 1% today. Now, we haven't done a show in a couple weeks. And again, thanks so much for your patience. I'm a big fan of taking time off. I often write about being mindful, taking time to reflect and focus. So it'd be pretty hypocritical if I didn't take some time off myself at year end and show you why it was so important to me. So I did it. We took about 2 weeks off, having holidays here in Seattle and then traveling around the country, visiting some of our family. And really good to be back home, but really enjoyed seeing some family members here that we don't see often enough. So since we haven't done a show in a little while, I do want to just mention briefly our market trend model. Now, this is a widget that is part of the Stock Charts member dashboard. So if you're a member, you can actually add this widget onto your homepage. I'd encourage you to do so because it's just a quick cheat sheet on what the trends are on 3 different timeframes using the methodology that I often share here on the show. As of last Friday's close, which is when we last took the snapshot here, I want to point out that the short-term trend models for each of these, large cap, mid cap, small cap, and the Nasdaq all turn negative. The medium-term model, which for me is the main one that I use for risk on versus risk off. This is the model that helps me define sort of my general risk appetite. Do I want to be adding positions or subtracting positions, or as I like to say, focusing more on capital growth or capital preservation? The medium-term model for the mid-cap index did turn bearish last Friday, and it's the first one of these four to actually do so. Now, the main one that I follow is the S&Ps. That's really the core index that I follow as a benchmark. So for now, short-term model bearish, medium-term and long-term models still bullish. Now, the reason why that's pretty important to me is because if the medium-term model would turn negative, all of a sudden the beginning of 2025 would look very similar, and not in an encouraging way, to the beginning of 2022. That's where you had some clear signs of a rotation from a very bullish year of 21 to what became a pretty painful bearish year through much of 2022, going into that major low in October. But as I look back and sort of think about how that year progressed, clear signs of distribution and the market trending lower in the medium term and eventually the long term models turning bearish were some of those great signs that I remember following that helped me understand that we needed to be more defensively minded through the course of that year. So for now, that is something I would absolutely be watching as well. So as we kind of take a moment here, thinking about where the markets are at, thinking about some of the growth versus defensive sector performance, and looking at things like volatility, I would say generally speaking, the trend is still positive. And I often get asked about being too bearish in a bull market. As long as the trend keeps going up, as long as stocks keep going up, I'm going to be bullishly positioned. And so I still own plenty of stocks. That's sort of the main bet that I'm making, is that the markets are going up, because I haven't seen enough signs that the market is not going up anymore. But some of the things that I mentioned, those are the warning signs I would be looking for. And I would say things like the Hindenburg omen, which we reported on in December, things like rates going higher, the yield curve becoming more normal shaped, recessionary risks, all of those things are red flags that suggest we may be around a market top. But until I see the trends rotate lower, until I see the charts reflect that the trend is actually reversed, I'm still going to want to own things going up. As I wrap every episode, it's always a good time to own good charts. And as long as the charts are still good, I'm still going to want to own them. All right, let's go to the market carpet. And love this visualization as a way of just sort of taking stock on what's happened through the course of a particular day or some other time period. Three things we'll do here. Number one, look at the overall impressions. What are the main takeaways? Number two, focus in on the biggest names that have the biggest weights in our benchmarks. And number three, look for some individual ideas, some lower themes and outliers. So to start off with general impressions, where you can see kind of a difference between some of the growthy sectors like technology and communication services, with quite a few boxes kind of bright to kind of bright green. Compare that to the defensive sectors here: staples, real estate, and utilities. And as I'm looking at this through the course of the day, I mean, definitely an offense over defense feel to the particular session today. We've talked about some of the warning signs. Again, now what I'm looking for is actual distribution, the price actually rotating lower. And I'm not really seeing that. Now, you are seeing areas of the market like staples, real estate, utilities down quite a bit today. And you can see some of the names in staples like Mondelez, Colgate, Palmolive, P&G, all down over 2%, in some cases over 3%. So, significant sort of rotation lower in some of the defensive areas. So you're not really seeing, that which could be a good sort of bearish tell for the market, is if defensive sectors start to improve. Not really seeing that yet. Also want to note, financials, that's certainly an area of opportunity that we've highlighted, given the fact that the yield curve is more normal shape. That would tend to be a good sign for banks, particularly regional banks that really make money based on the shape of the yield curve. And the steeper the curve, kind of the better that is for their business. Kind of mixed results today. You're not really seeing the follow through yet on charts like Key or Huntington or others. Regions Financial, Zion, that you see on the chart here. But the brightest red that you see in the financial sector, not in regional banks, it's things like the CME group pulling off of all-time highs, things like Jack Henry actually breaking to a new swing low, pushing below the November low around 170. So a bit of a modeled appearance, because at the same time you see Citigroup and Morgan Stanley actually pushing back higher toward the previous highs that we saw in December. let's look at the biggest names here to finish off. And I would say, obviously a significant up day. And when you wonder why the benchmarks are up so well today, it's Nvidia up over 3%, Meta up over 4%, Alphabet up about 2.5%. These are some of the biggest names, and they're having pretty decent updays. Alphabet, that makes a new all-time high. Nvidia, slightly new all-time high. I don't think Meta slightly got there. I'll have to check the chart here a little later, but obviously quite a bit of follow through. I also want to notice in the technology sector, some of the names like AMD, which have been fairly negative charts. Applied Materials, these are some of the semiconductor names that have had a really weak Q4, actually bouncing higher quite a bit. And I didn't include KLAC, but I wanted to just point out that a stock like this, one of the biggest gainers in the S&P today, obviously coming off of a fairly weak level. But one of the things we talked about going into the beginning of this year, do you see a reinitiation of leadership from semiconductors, which is a bellwether group that I think often is an important one, because if semiconductors are doing well, it's hard to be that negative about the markets because they're sort of the backbone of the modern economy, right? Obviously, driving devices and the internets and all those things that we rely on so heavily these days. So KLAC and others having a nice rally. I would say today's move encouraging in that pushes KLAC back above the 50-day moving average. On Friday, we actually closed above there for the first time in a couple months. It was back in mid-October was the last time we actually closed above there. But since then, I think still what you want to see is continued follow through. After you have the gap like you did today, clearing those swing highs from December, what happens tomorrow? To see additional buyers coming in. But for now, I would say at a surface level, nice upside move and encouraging to see stocks like this that have been underperformers in Q4 actually starting the new year, at least this week, starting in a position of strength. All right, let's finish off the chart review, and then I'm happy to take some questions. As a reminder, we are live streaming on Facebook, LinkedIn, YouTube, and X. I can see questions you put in on any of those platforms. So wherever you're watching the live stream, make sure you drop a question as we go. I'll try to take a question or two before we wrap the live stream. And of course, if you're watching this a replay on our YouTube channel, put a comment below there, and maybe we can answer it in our special all mailbag edition. Next one will be this Friday's episode. So the chart of the S&P 500, right? I mean, initial reaction is this is a very toppy sort of looking chart, but I would hesitate to declare this a head and shoulders top because it hasn't completed that pattern just yet. And I will tell you, going into Friday, as I was reviewing the charts a little bit on the flight home from Fort Lauderdale on Friday, we're flying across the continent, and I'm looking at some charts just to sort of reconnect with the markets and think about what the patterns that I'm seeing. And I would say the S&P looked concerning into Thursday's close because we had traded below this neckline. Now, you can draw this neckline a little different ways. And again, just to take a step back, here's the head in December, left shoulder in November, left shoulder in late December, and here's a neckline. Now, the textbook would tell you to draw the neckline a little downward sloping to take the swing low there and the swing low here. I just kind of did it quickly as that's as best as I could draw a trend line on a turbulent flight, but that's kind of what I was getting at, just reinforcing the level of 58.50. This has been our line in the sand for a while, so I'm not too surprised that we have this head and shoulders like pattern developing with the 58.50 level as essentially the neckline to that pattern. What this means is until and unless we break below 58.50, chart's not that bad, right? We have put in a lower high around 60.50 about a week and a half ago. That's true, but we're not really breaking down, right? And so a downtrend would be lower highs and lower lows. So if the S&P starts pushing below 58.50, undercuts these lows from mid-late December, that's when I would say we're in a clear pattern of short-term distribution. That's when you start to look for downside objectives. If we would close below 58.50 and have a confirmed breakdown of that neckline, I would assume sort of that 5,600 range, which would be the 200-day moving average. That'll also be the height of that pattern subtracted from the neckline. That kind of gets you down to that same level. So I think of this sort of pattern as an if-then statement. If we break 58.50, then downside potential to around 5,600, then we reassess. But unless we break below 58.50, I'm still thinking this is a bullish overall pattern. So again, the leading indicators that I think about, things like the shape of the yield curve, the dollar rallying, breadth deterioration, all of those things are telling you the conditions could be set up for a breakdown. Now it's, do we see the breakdown? 58.50 is that level. That's where I have an alert set. I would encourage you to follow that as well. For now, it's holding. I shared on the earlier in the market recap about the market trend model, and just wanted to show you the chart because we haven't seen this in a couple weeks now. As a reminder, the short-term model did turn negative. It is slightly higher. That's just with today's rally. So I don't formally update the model until Friday's close. So as of last Friday, short-term bearish, medium-term still bullish, long-term still bullish. What I'm looking for on this chart will be the medium-term model turning bearish. It has been bullish since early November of 2023, essentially telling me to be risk on through this entire period. That has served me quite well. I'm looking to see if and when. It's really more when we break below there. I don't know when it's going to be, but when it does, I'll certainly be thinking more defensively, and I would encourage you to be reassessing your risk appetite as well at that point. Wanted to highlight sort of an interesting anomaly that happened today. The Chaikin money flow is my favorite way of analyzing trends in volume. This is an improvement that Mark Chaikin made on simple analysis of volume, and I would say really improved on Joe Granville's very simple but interesting innovation of looking at volume over time by adding or subtracting the day's volume based on where we closed. Mark Chaikin improved on that even further by actually looking at where we closed every day versus the high-low range. And if we close more the lower end of the range, that's distribution. If we close near the higher end of the range, that's accumulation. And so you use that ratio of where we closed within the range and apply that to the daily volume reading. And that's basically what the Chaikin money flow is telling you, is over a period of time, where are we at over what sort of volume are we seeing on the days where we close near the highs or near the lows of the day. The Chaikin money flow turned bearish. It went below the zero level a couple weeks ago, right around a week before Christmas, around the 16th or 7th, maybe 17th or 18th of December, that is, and has remained bearish. Now, we gapped higher today, but the Chaikin money flow actually continued slightly lower, and that's a little counterintuitive, right? If we closed higher than Friday's close, why is the Chaikin money flow negative today? And the reason is because it doesn't account for gaps. So the Chaikin money flow is actually just looking at today's trading. And because we closed slightly below the midpoint of the high and the low, today's volume is considered distribution volume. And so that's why the Chaikin money flow is going negative. So overall, the Chaikin money flow is still negative from mid-December. That tells me that we're seeing more distribution volume than accumulation volume. And overall, that is, again, one of those other sort of red flags that I see on this market, is you're not really seeing accumulation days, big moves higher on heavier volume. It looks more like stronger selling as reflected by that particular indicator. Now, breadth conditions, we cover that pretty often here, and I think we covered pretty well in the month of December how the volume or the breadth conditions had deteriorated. Indicators like the advanced decline lines, the McClellan oscillator, have all given bearish signals. The bullish percent index on the S&P 500 gave a key sell signal in December, all suggesting that breadth conditions were getting less bullish. I did want to highlight just on the bullish percent index on the Nasdaq 100. So this is different than the one we normally look at, which is based on the 500 members of the S&P 500. This is looking at a very growth-oriented index, the 100 members of the Nasdaq 100. What percent of them are in a bullish point and figure pattern right now? At the end of last year, that is down to around 35%. Just in the new year, it's popped all the way up to around 56%. So that means about 20% of the Nasdaq 100 members have generated a buy signal on their point and figure chart just in the last week or so, right? Just in the new year. So this is one of those things I think you want to look for are, changes in character where indicators have had one trend and all of a sudden start to evolve. One of the sort of more encouraging signs, excuse me, that I'm seeing here so far, early days of 2025, is a nice pop in the bullish percent index on the Nasdaq 100. That's not a sort of classic buy or sell signal. I look at extremes on this particular indicator for the main buy and sell signals, but I would say it really speaks to the reemergence of strength in some of those growth sectors. And I'd say if you're bullish, if you're all bulled up for Q1, you need to see indicators like this really continue to push higher and have this not be sort of a dead cat bounce kind of quick rally. So watch this sort of chart as well to see if we see continued improvement in indicators like that based on point and figure charts in the growth space. The name exposure index has had quite a bit of a shift here in the last couple of weeks or over the holiday season. The name exposure index has gone from around 100% in early December now to around 64% in early January. As a reminder, this stands for the National Association of Active Investment Managers. It's a survey of money managers, a lot of wealth managers, people that manage other people's money, and they respond to a weekly survey of what their exposure is percentage-wise to the equity markets. And at around 100%, a couple weeks ago, that's getting to a danger level. I have a red line around 100 because over 100% to me is a sign of euphoria, that money managers in this poll are too bullish, too bullishly positioned, too optimistic. And as a result, we might get a counter trend move back to the downside. In the last, last couple of weeks, we've seen the indicator go from 100% down to around 64%. Which tells me investors are starting to tap the brakes on their bullish positioning instead of being all in bullish as they were at the beginning of December. This is actually underweight equities based on the historical averages in the survey. So one danger sign is money managers in the name exposure index getting a lot less optimistic and really pushing on the brakes here a little bit. All right, offense over defense. This is an important chart because for me, tracking rotation of institutions from offensive positioning, betting on the market going higher, to defensive positioning, sort of hiding out in defensive areas of the market. It's a very important market tell that I've followed for many, many years. The bottom series here is looking at the equal weighted consumer discretionary sector versus the equal weighted consumer staples sector. So looking at offense over defense, that ratio made a new all-time high today. So we are not seeing that sort of traditional warning sign of investors getting more defensive. This tells me that investors are remaining sort of bullishly positioned, certainly not rotating to defensive sectors like consumer staples, utilities, real estate. That sort of rotation would make this ratio go lower. This has been bullish really since mid-September when it made a higher low and has been trending consistently higher for the last three months. So no warning sign really there. Do want to highlight the chart of Bitcoin. We pulled back to around 92,000. That was going into the end of the year over the holiday break. Today, we're having a nice upside follow through as equities kind of going more risk on today, and the market's generally trending higher. Bitcoin currently pushing higher as well. We're just below 102,000, the all-time high here from mid-December around 108. We now appear to be rotating back to test that previous high. On that pullback at the end of the year, I do want to point out that the RSI stalled out around 40, and that's probably one of the more encouraging signs on the chart is that the momentum is very firmly in the bullish range. So you did get quite a bit of a bearish divergence here going into the December peak. We pulled back around 15,000 on the value of Bitcoin, but overall we're now reinitiating the uptrend. The momentum is improving, and that's something you want to continue to watch on the chart of Bitcoin. All right, some individual charts to individual stocks to finish off our chart review, and then I'll take a question or two to wrap up today's show. NVIDIA and other mega cap growth stocks, obviously so important to watch. We pay attention to them every day, but certainly try to take a clear assessment of the conditions here because there's such big weights in the major averages, the S&P and the Nasdaq. NVIDIA having a nice finish to the week. On Friday, we actually gapped higher and closed just below 145. Today, opening even further to the upside, and we're now once again testing all-time highs right around 150. As a quick reminder, we hit 150 here in November, early days of November, mid-November. We tested that level again. We then broke down to around 126, 127 here in mid-December. Now we've round tripped all the way back to those previous highs. The bull case for stocks here, I would argue, has to include charts like NVIDIA and Meta and Alphabet reinitiating the uptrend, breaking out of this consolidation that really has been in place since October and sort of following through to the upside. Today, we're back to retesting that resistance. My alert was set for NVIDIA 150. It triggered earlier this morning. I look to see if we can close above that resistance level and follow through. TBD, we'll see what happens through the remainder of this week. Alphabet, also a pretty constructive chart here. We can see the high in July just above 190. We pulled back to around 147, but then retested those previous all-time highs. Then we have a bit of a pennant pattern, which is when you have a rally and then a consolidation of lower highs and higher lows makes like a little pennant. And today we are breaking out of that pennant pattern to the upside. So Nvidia, Alphabet, two of the Magnificent Seven names, having a nice upside follow through today. I would say overall these charts are in a position of strength. I would assume that they are innocent until proven guilty. For now, they are telling me the bullish outlook is pretty safe until proven otherwise. Elsewhere, Micron, we talked about semiconductors and some of the nice bounces we saw today. Micron was one of the better performers. Might have been the top stock in the S&P. I neglected to note that earlier, but I think it was up over 10% today. Now, remember, Micron has been a pretty rough chart. What's interesting is at the end of December, we're bouncing off of support around 85. Early August, we can see testing that level. Mid-September, testing that level once again. We rallied up to a clear resistance level around 112 to 114. We once again sold off to test support. Now we're trading back up towards those levels. And I would say certainly appears likely we're going to retest that level. Now, the problem here is we have a lot of overhead resistance. We have the 200-day moving average around 110. That was last tested in December, and we had a pretty clear distribution off before the gap down to the mid-80s. I would also say the 38.2% retracement of that June to July sell-off is right around 112, and that lines up really well with some of those previous highs. So we have what's called a confluence of resistance, a bunch of different indicators all telling us a particular area is going to be meaningful. That tells me get excited about something like Micron until or when and if and when it can get above that previous resistance level. I think this chart above 115 is a really bullish chart, but until then, it's more range bound. I don't think anything better than that just yet. You're seeing a lot of names bounce off of positions of weakness. Align Technology, which is a medical supply company in the healthcare sector. You can see this bounce off of 205 in late October, again in late December. Now we're rotating higher. I still think much more to prove, right? You want to get above the 50-day, make some sort of higher low. But overall, I'm seeing a lot of names that are bouncing off of positions of weakness. So going into the new year, that's sort of the question is whether you see a return back to risk on with some of these names that have been underperforming in December, starting to improve a little bit. We're seeing some early signs of that. Now it's do we get the follow through the course of this week? I'll finish with Palantir, PLTR. You know, when I think about the charts that I've shown you today, when I think about what I would be looking for going forward, what sort of key charts to watch. Besides the Magnificent Seven, I think something like PLTR is a really interesting one. I mean, some software names like Palantir have been absolute, rock star charts through 2024. I mean, if you own this chart, if you have a one stock portfolio in 2024 and it's Palantir, you're probably really happy with your performance. The problem is some of these names that have been so strong are showing clear bearish divergences, right? With higher highs in price November, December, and lower peaks in momentum. So the risk to this market, besides mega cap names struggling, would be charts like Palantir, which have been just the absolute outperformers. I mean, the sort of perfect example charts that you'd want to own. If they start to not work, then there's a vacuum in leadership, right? What takes that leadership role? And if charts like Palantir start to fail, I think there's two general rotations you could see. Either a rotation to cyclical leadership, like energy, like financials, like materials, or defensive leadership. And I think that would be the dangerous outcome to observe, because if investors rotate out of Palantir and start buying a bunch of utilities, that tells me to be concerned that we're probably going to see further weakness. Thanks so much, guys, for watching today. And I see some questions in here. I'm going to take a question or two. I got a question on Palantir, and I would just say, so overall, again, to be clear, I think the chart is still strong. I think the chart of Palantir is an example of some of the issues I see in this market, which are early warning signs like bearish divergences are starting to flash. Now you look for confirmation telling you that this is something you might be worried about. Yes, you should definitely be worried about it, which is price breaks down. And I don't see anything negative on the price of Palantir just yet. I see weakness in momentum, right? So sort of underneath the hood, it's telling us we might be at a major top. Usually that's not enough for me to start selling. I wait for a breakdown in price, but this tells me to put PLTR and other charts like it on a watch list, be watching them closely to look for signs of deterioration, look for sell signals on indicators like MACD and other things that are more trend following indicators. That's what I would do on the chart of PLTR. Joanne, thanks so much for watching on YouTube. You asked, any comments on the chart of TLT? Any signs of bottoming yet? Yeah, we highlighted earlier, and thanks for watching. I highlighted earlier the chart of the 10-year Treasury yield. I didn't show it though, now that I'm thinking about it. So I'm glad you asked about this. So, the 10-year Treasury yield, obviously, going higher. And that's sort of the main, sort of thing I'm thinking about in the interest rate space, the shape of the yield curve, rates going up. So the 10-year yield went from 3.6% up to around 4.6%, which is where we're at right now. And as the 10-year yield is going higher, the TLT and other bond price indexes are going down quite a bit. So there's your peak in mid-September where the TLT hit 100, and now we can see we're down to around 89. So pretty good 10 to 15% drop, 12-ish% we'll call it on the TLT. So, what are we seeing now? So I would argue like you're not really seeing any sort of divergence. You're not seeing any upward trend in momentum. I'm still seeing the trend go lower. So the TLT is in a clear downward trend of lower highs and lower lows. I think the most telling sign on this chart was when the TLT rallied to 94 in early December. You see the RSI stalled out around 60. So what's happened is the entire range of the RSI went from a bullish framework to more of a bearish framework. And I haven't updated it with a little red box, but I pretty much want to do that right now. I'm doing it right now. It's happening. All right. So what we do is I like to take this. I like to take a copy. There we go. And then kind of move it over, and I'll tighten that up and make it look prettier a little later. But this is kind of what I'm looking at, right? In a distribution phase, when a trend is downwards, you see the entire range of the RSI go down. And I say until proven otherwise, that tells me that bond prices are in a period of distribution. Rates are going higher, and I'm not seeing signs of that sort of reversal just yet. A person, I love your very clever handle there. How often do you do these live shows? We'll wrap the show here, but I will tell you, thank you so much for watching. We do this every weekday after the close. This is our market recap show called Chart This with Dave Keller. We do this every weekday after the close. We aim for 5 p.m. Eastern, 2 p.m. Pacific. I'm pretty good at hitting that mark. We have a new and improved shorter intro, about 12 or 13 seconds down from a minute. So always looking to improve, but I appreciate you guys watching. If you're watching the live stream, appreciate you watching the replay on our YouTube channel. Please make sure you put your comments in, any questions that you come to mind as you're watching the show. Anything we don't get to on the live market recap, we'll put in our mailbag. We'll do an all mailbag edition coming up this Friday. Hope to answer your question live on the air. For Market Misbehavior, I'm Dave Keller. Thanks so much for joining me here on the first show of 2025. Have a great evening. And remember, it's always a good time to own good charts. Take care, folks.